the financial system is effectively, or financial markets are effectively just an allocation mechanism for society's resources. And so when financial systems go wrong and create imbalances or create the wrong incentives in the system, you can have quite catastrophic effects. And this is why I've looked at this particular question of the China-US relationship from a financial markets point of view, because I think that actually this is a really important topic, and it's very much underappreciated on both sides, even by a lot of top policymakers involved in making key decisions.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary people from all around the world. In this series, I have invited one of them, namely Kevin Coldiron, to host a series of in-depth conversations to help uncover and explain new ideas to make you a better investor. In the series, Kevin will be speaking to authors of new books and research papers to better understand the global economy and the dynamics that shape it, so that we can all successfully navigate the challenges within it. And with that, please welcome Kevin Coldiron.
All right, Niels, thank you for the introduction, and welcome everyone who's listening out there. We are very fortunate today to have with us James Falk, who's written Financial Cold War, a view of Sino-US relations from financial markets. We all know that prediction is difficult, sometimes dangerous. But one prediction I'm pretty comfortable making is that the relationship between China and the US is going to be central to all of our economic lives going forward. And we're really fortunate to have James with us today to talk about that relationship and how it could and should change over time. So James, welcome to Top Traders Unplugged.
Great to be here. Thanks for inviting me, Kevin.
So you've got a unique personal perspective and background. I think that's what makes the book so interesting. Could you tell us a little bit about that? Tell us a little bit about yourself, your personal life, your professional life, and then, why you decided to write the book.
Mine's a very typical Hong Kong story. So I come from a mixed Chinese-British family. I grew up in Hong Kong, spent some time in boarding school in the UK, did some undergraduate in Beijing, then started working as a banker in an investment bank in London. And eventually I found myself advising after I moved back to Hong Kong with my wife in 2008, found myself advising on the London Metal Exchange acquisition for the Hong Kong Exchange, and ended up working there for almost a decade. And through that, had the opportunity to interact with a lot of policymakers in China, Hong Kong, in the US, and internationally, as we were essentially sitting in the middle of a lot of the major China capital markets internationalization moves, like Stock Connect, Bond Connect, which were launched during that period. And so I had this kind of seat at the table view of what was going on. And also, it happens that my wife's American, and, I had a lot of opportunity through her and her family to spend time over here and managed to get a lot of personal insights on the US and thinking over here that I might not otherwise have got.
Yeah, that, and I want to circle back to this, but that balance of perspectives, I think, is what I really appreciated from the book. The fact that, you talk about both systems, and you're critical of both systems, but you present, and particularly the view of Chinese history and politics in ways that I hadn't heard of before. And so I'd like to talk a little bit about that. But, I guess one thing that I'm curious about, and I'm sure our listeners would be, is, you're a Chinese national, and the book is fairly open in a lot of ways. Is your book available in China? I mean, if I went to China and bought this book, would I be reading the same edition that I get if I buy it in New York?
It's in the bookstores in Hong Kong. There's no Chinese translation yet. Maybe if it does really well, that there's an opportunity that might be someday, and I hope it will be available in China.
And you, like I said, the book is fairly balanced. I mean, you talk about Chinese history and politics, and you're in quite an open way. So if it was available in China, would it be an edited version? For instance, you talk about Tiananmen Square. Would that have to come out of the book, do you think?
I don't know. I guess we'll wait and see. I would say though that being a reader of both languages, if you translate from one language literally into another, you quite often miss a lot of the meaning and particularly the nuance in one particular language. I know friends who've written books and very successful books who have written basically completely different books in the two languages, not because of any worry about censorship, but because you just have to write in a very different way for different audiences to get your meaning across.
Do you have a sense for how well the book is, doing in Hong Kong?
Well, I haven't been completely panned yet, which is a relief. and a few people have even made some very, very kind and complimentary comments about it.
Okay, so the book is called Financial Cold War, and I think the key bits of it deal with finance, and so I want to kind of get there, but I would like to start off sort of more broadly, because in some sense that's kind of how you tackle the book. If I was making an elevator pitch to readers, I'd say that what I really appreciated is the history and the balance. So you don't just say, hey, here's the relationship between China and the US, and this is what we need to do to fix it. You walk us to that point, how we got to the current relationship, by talking about history, and as I said, it's balanced, and you're critical of both systems or aspects of both systems. So, if we could, I'd like to just pick out a couple sort of historical points where you presented a perspective that I hadn't heard about, and maybe just ask you to elaborate a little bit on that, and then we'll kind of work our way from that to the kind of current recommendations. So, for instance, Tiananmen Square, you talk about that, and you talk about the demonstrators there, students at Beijing University, not really demonstrating for democracy, more like, hey, we want more freedom in choosing our jobs after we graduate. And then the second thing you talk about in terms of that is the reaction of the Chinese leadership at the time was very much informed by what had happened to the country during the Great Leap Forward. I mean, you talk about China experiencing a virtual societal collapse during the Great Leap Forward, and that concern, informed how they reacted. So would you mind just kind of expanding on those points a little bit for our listeners?
Look, I mean, I was a child. I was studying in Hong Kong when Tiananmen happened, so it was something that was very real to me. We watched this on television. There was a huge outpouring of sympathy and grief in Hong Kong. Mainly, I think because that it also highlighted or it captured a lot of the fears in Hong Kong society at the time. And my view on political systems is that every country arrives at its own in its own way, and it comes out of its own historical and cultural context. And when you look at the reasons why you have overturns of regimes throughout history, it's not necessarily because of the particular governance system that exists in that country. It tends to be because of very mundane livelihood issues. It's whether people are able to feed themselves, whether they have access to opportunity, whether their lives are getting good, better, or whether they're getting worse, whether the prospects for their children are getting better or worse. And this is something which I've seen again more recently in Hong Kong, in many of the drivers of the unrest that we've seen there, in that there's I think quite a primitive narrative in much of the international press and commentary on what's going on, that it's all about the political system or democracy or things like that. If you're on the ground, actually, the thing that most people care about are they able to get their kids into good schools? Are they going to be able to afford to pay the school fees? Are they going to be able to afford to get on the housing ladder? Are they able to live with a level of comfort and dignity? These are the things that really matter, and these are the things that financial systems are responsible for. The financial system is effectively, or financial markets are effectively just an allocation mechanism for society's resources. And so when financial systems go wrong and create imbalances or create the wrong incentives in the system, you can have quite catastrophic effects. And this is why I've looked at this particular question of the China-US relationship from a financial markets point of view, because I think that actually this is a really important topic, and it's very much underappreciated on both sides, even by a lot of top policymakers involved in making key decisions.
So just picking up on that point about Hong Kong, can you, it's been, as you said, I think in the Western press, it's, quote unquote, pro-democracy demonstrations. But in the book, you talk about how radically Hong Kong society has changed in the last few decades. And, it's just become a very exceptionally unequal place. Can you just give us a little more kind of color on that, and that, why that might have led to people being kind of sort of dissatisfied?
Well, Hong Kong's not unique. These things are going on around the world. It so happens that we in Hong Kong hew to a very free market, laissez-faire philosophy of economics and governance. And so there's very low rates of taxation. There's no taxation effectively on income derived from capital. And so many of the inequalities that you see arising around the world just have arisen more quickly in Hong Kong than in other places. And so in many ways, you can look at the events in Hong Kong as being predictive if other places continue following down the same track.
Yeah, I think there's a lot of it's just interesting because we're all focused on what's happening in our own particular society. So wealth inequality gets a lot of play over here, but not so much in China. I think partly maybe because the data isn't as readily available. And you actually frame a couple of more recent events, I think, in that context where China's kind of cracked down on both tech companies and for-profit education companies, and the narrative that we heard here is more like, oh, hey, they were never serious about capitalism. The government's intervening to direct capital, and you framed those, I guess, that government action more in the context of, hey, actually, they need to take some action to rebalance inequality in the system. Could you elaborate a little bit on that perspective and particularly for the for-profit education companies?
Well, you're right that this issue of wealth and income inequality is not as acute a political issue in mainland China as it is in the United States here. But levels of wealth and income inequality, and data is available, are showing that China has now reached levels of wealth and income inequality that have even surpassed the US. The reason why it's not as acute a political issue is because the economic development has happened over a very short space of time in China. And over the last 40 years, the vast majority of Chinese people have experienced a significant increase in their standard of living. So the trajectory has still been good for most people. I think that this is something that is going to become more of a political issue. And in fact, even by the time that President Xi came into power in 2012, this was beginning to become an issue, along with, frankly, quite rampant levels of corruption in many parts of the system. And so his administration has pushed to crack down, largely because these problems were starting to undermine the legitimacy of government. And there are many different perspectives on why it's being done, how it's being done, and so forth. But by and large, these policies have been extremely popular in China. But when you look at the issue of the platform monopolies, the big internet platforms, this is not a unique China phenomenon. This is a global phenomenon. And actually, the United States so far has really failed or abdicated its responsibility for controlling or better regulating these platforms. China has taken quite a proactive approach, and you can quibble about the lack of due process in doing that, and that's what a lot of international investors are spooked by, because the Chinese system allows you to cut through, or allows the government to cut through all the niceties of due legal process and get to these problems very quickly. I think that may not be the best approach, in that sometimes by cutting through due process, you miss things, or you just undermine systems where China's economy has really been powered by private enterprise for the last 20 years. And if individual entrepreneurs cannot be secure in their property rights, then will they still have the incentives to innovate and drive enterprise?
Just that you brought up due process and kind of rule of law, and that plays a big role in a lot of your recommendations, and that we'll get to. But you also, kind of say that there's a skepticism, or a skepticism, I guess, of kind of the quote unquote, rule of law or laws-based system within China. Is that right? Am I that it is kind of viewed with some skepticism? It's not seen as kind of core to economic development in the same way that it would be in the West.
They run a very different system. So if you look at the history of China, even going back to the dynastic period, China has a huge firewall between the state and private enterprise. And, there was a very brief period post the fall of the Qing dynasty under the nationalist government where enterprise and government became intertwined, and there were rampant levels of corruption, and the standard of living for many of China's populace was quite poor. This is what drove the Communist Party into power in 1949. If you look at the United States system, it has a different history, and government and private business are deeply intertwined through campaign funding, through the revolving door of personnel switches between public office and private enterprise. I think both systems have their pros and cons, but China's system hews much more to its traditional system of government, where the government wants to keep the influence of private enterprise on the policies of the state to a minimum controllable level. And so when you look at you asked specifically about the crackdown on the for-profit education companies. These, if you look at China today, I mean, they face a huge demographic cliff. People are not having enough babies. Last year, the fertility rate fell to 1.3, which is the lowest ever, far below replacement rate of 2.1 per woman that's required. And so one of the big pressures that's putting people off having children, friends of mine are dealing with this. People are having to buy these really expensive apartments in particular school districts in Beijing to try and get their kids into the better schools, because the system for the competition for university places at the top universities is so fierce, and the for-profit after-school tuition centers effectively play on this competition, play on this fear, but they're very expensive, and so this creates an additional pressure on parents and families. I don't know whether it was the right answer to crack down and ban them, but you can certainly see the reasons why the government did so.
Yeah, and I just thought that was an interesting way to frame it. So something that I hadn't seen as trying to deal with inequalities in the system, and that's certainly something that we've got over here. As you were telling that story, I remembered an incident that happened to me a few years ago. I was teaching a course in Qingdao, and this was 4 or 5 years ago, and the locals were very friendly, but also not. They didn't talk much about politics. The only thing that someone said to me was on the back of my phone, I had a picture of my kids. I've got 4 kids. And one woman said, well, when I see your family, it makes me sad because, I'm an only child. All my friends are only children. And, I miss that. And so that was the only kind of even a veiled criticism of the kind of political situation there. But, despite that, people still obviously aren't in a position economically that they feel they can have bigger children, bigger families, even though they could if they wanted now.
This is a global phenomenon, but I mean the one child thing has become somewhat embedded in in society, not just because of the financial and other pressures and higher levels of female education and participation in the workforce in China, which are global phenomena, but you had this one child policy for more than 2 decades, and after that period of time, that sort of becomes normalized, or it's a normative phenomenon, and so people don't necessarily expect to see people with lots of siblings.
Okay, let's pivot a little bit and start working our way towards kind of the financial system and the financial relationship between China and the U.S. So I think we're all familiar with the notion that the U.S. has had a balance of payment deficit with China for a long time, and that's been a political flashpoint from time to time, certainly with the Trump administration. You kind of say, hey, actually, if you think about it, it's not so much that the U.S. has a balance of payment deficit with China, but it's really a balance of payment deficit with the rest of the world. Can you explain what you mean by that?
Well, this is a figure that's moved around a bit over the years, but I mean, China basically fixed their currency against the US dollar for a decade between 95 and 2005. And this meant that, as China's economy grew, as productivity grew, the currency became seriously undervalued. In 2006, I think China's current account surplus got to something like around 10% of GDP. By 2018, actually, China's current account surplus as a percent of GDP had fallen to 0.2%. So it effectively had become flat. But yet at that time, it was still running 400 odd billion of surplus against the US. So that meant that effectively China was running a deficit against the rest of the world. Now, since COVID and the sort of various disruptions that's inflicted, China's current account surplus has bounced back. I think it ended up last year at a record level of $670 odd billion. But really, the issue is not necessarily so much China's surplus anymore, because China is consuming more. Common prosperity is a drive to redistribute China's wealth so that the bottom half or the bottom part of China's population can consume more. So in that sense, the problem that I think needs to be looked at is, why is the US running these persistent deficits? And much of that lies in the fact of the US dollar serving as this global utility in trade and investment. In order to keep it serving in that function and to provide liquidity to the rest of the world, the US has to run constant balance of payments deficits to supply dollars to the rest of the world. And the problem with that is, it's all well and good when the US economy is growing at least as fast as the rest of the world, but the US is now a big, mature economy, and other countries have been growing a lot faster, which means that the US has had to go into higher and higher levels of debt, which has created a fundamental fragility at the center of the US financial system, which, again, because the US system's centrality in the global financial system has created fundamental fragilities at the center of the global financial system, which is the theme of your book. The other issue also is really the uneven impact of this in the US, because this has not been a terrible thing for everyone in the US by any means. If you've been, over the last 40 years, the wealthy shareholder of a large US corporation that's been able to take advantage of this phenomenon, i.e. the structural overvaluation of the US dollar because of the demand internationally for the dollar in trade and investment, then you've done quite well, because these companies have been able to offshore their production to lower cost centers with undervalued currencies quite often, and they've been able to lower their costs, improve profit margins, and the share prices have done remarkably well. If, on the other hand, during the same period, you've been a US manufacturing worker, your story has been one of displacement, job loss, or at best, long-term wage stagnation. And this is what's been one of the big issues that's been driving huge wealth and income disparities and widening disparities in the United States.
Yeah, and so essentially that's a cost to the U.S. of the dollar being the global reserve currency, and that's a important theme of your book. I mean, when the dollar is talked about as the global reserve currency, it's always, or not always, but certainly for the most time, framed in terms of the advantages it confers on the U.S. It's our currency, your problem, and you're saying, hey, actually now the overall costs of the dollar financial system are greater than the benefits to the U.S. So are there other costs that you have in mind aside from the fact that it's, made manufacturing in the U.S. uncompetitive and led to kind of reinforcing wealth inequality? Are there other costs that you have in mind, or are those the primary ones?
Well, a very topical one is actually the power that it gives the US over its strategic rivals. And this is, I think, one of the key impediments to ceding this position of centrality for the dollar. If you look at what's happened in the wake of Russia's invasion of Ukraine, there have been massive sanctions levied over the Russians. Their central banks' foreign exchange reserves have been frozen. These are unprecedented moves. And the reason why these moves can be made is because the United States and the developed West largely control the international infrastructure that support the global financial markets, the infrastructure of payment networks, of international depositories, of global custodian banks, and so forth. I think you have to take a step back and look at the consequences of weaponizing the global financial commons. And I think that this is something which is not necessarily particularly thoroughly thought through. If you look at conventional warfare, there is an established principle of non-combatant immunity. No such principle or no such rule exists in financial warfare. And so if you look at the Russia situation, the first order effects of the sanctions were that you had a spike in oil prices and you had a short-term run on the ruble. Subsequently, you've seen violent protests break out in Sri Lanka, which has no direct involvement in the Ukraine situation whatsoever, as a result of the spike in fuel prices and fuel price inflation that their people are experiencing. And so Sri Lanka's just been kind of sideswiped in this process as a second order effect. And if you think about the third order effects, given the way in which global markets are intertwined, the effects can be extremely unpredictable. But if you consider that you have a whole bunch of countries, export nations, whether it's in Asia or Latin America, who are selling their commodities and their labor in return for generally US dollars. If they lose confidence that come the rainy day, or if they happen to get on the wrong side of the US, that they will be able to access those savings that they've accrued, then are they still going to be willing to sell their goods? Are they still going to be willing to sell their labor to support the lifestyles of the developed West? And then what would that do for inflation? How would that impact social stability in the United States and Western Europe. I think that when you get into the weaponization of the financial commons, it's something that can have huge, unpredictable consequences that can be absolutely catastrophic and which are quite indiscriminate in the way that their costs fall. I think that is a big disadvantage of the system, because by granting to any one country that power, you also create insecurity for all other countries who are stakeholders in the system, and it undermines trust. In many ways, the tensions that you see between China and the US today are a direct consequence of the undermining of trust between the two countries. Now, let's take the China example. China has got a very rapidly aging population. They have underdeveloped domestic capital markets, which has meant that most people's savings have been skewed into residential real estate. Residential real estate accounts for 78% of Chinese urban household wealth. That compares with around 35% in the United States. The second biggest pool of China's savings is in cash deposits at banks. This is a pool of 35 trillion US dollars of Chinese savings in the form of bank deposits. If you think about the needs of that aging generation to fund themselves through their retirements, what will hopefully be a long and healthy retirement for all of them, they need desperately to get those bank deposits into higher yielding, better returning capital markets assets. And China's domestic markets are very large, but they're not anywhere near large enough and deep enough to absorb that amount of capital within any short space of time. And so China needs to find channels for that investment to get out into international capital markets. The problem facing China today is that they've seen, as with the Russians, that given the West's control of the financial infrastructure supporting any Chinese outbound investment outside of mainland China beyond Hong Kong, they've just realized that they cannot put themselves at that financial security risk. This is bad for China, and it's frankly bad for the West, who would be more than happy to receive that Chinese investment. Think of all the bridges and roads and railways and upgrades in infrastructure that you could achieve in the United States if you were able to access that capital. At the moment, the fact that there isn't a secure way for China to be able to get that capital out means that China is stuck with pursuing international investment through Chinese corporations and foreign direct investment, such as things like the Belt and Road Initiative. The problem with that is that, and China has a lot of state-owned enterprise as well. So these companies going and buying whole companies or large assets in other countries inevitably leads to sensitivities about the level of Chinese government influence, the level of Chinese government control, technology transfer, jobs transfer. If you had 1,000 Mrs. Wangs from Chongqing buying a few shares of Alphabet or Amazon, nobody's going to care. So to summarize, I would say that the costs of the dollar system, that there are macroeconomic costs which bear on lifestyles and issues like inequality in the United States. But the system itself creates fundamental insecurities in the global financial commons, which are in many cases driving significant tensions and conflicts between the two countries. And what's more is that some people will argue that, well, it's better kind of pursuing this financial warfare rather than, getting the guns and tanks out. But the reality is that I don't think that financial warfare prevents that outcome. It's just part of a tit-for-tat escalation that leads you on to a path to not a very good place. And so, and in many ways actually probably exacerbate the tensions. So I think that these issues have to be thought about in a more holistic and mature way. And ultimately, I think it's in everyone's interest to see a reform of the system in a way that can give all stakeholders in it greater security.
Well, it's there's a lot to unpack there, and there's different ways I could take the conversation, but I guess that sort of balanced and nuanced thinking is what I really liked about the book. And I know you said before we started the show that you've been talking to people at the Federal Reserve and in the U.S. government, so hopefully that perspective is getting through a little bit. But I as you were just talking about it, the analogy that popped into my mind is, kind of the Federal Reserve's impact on the U.S. economy, and that it's in the short term, it's used its power to to kind of stabilize markets, but in the long term, those actions have basically created fragility in the system and actually undermined its own power long term. And I think sounds like really what you're saying with the dollar system is that it confers a lot of short-term power on the U.S. to, in this case, say, freeze Russia's central bank's assets, which seem like a powerful weapon, and they are, but that the kind of butterfly ripple effects create, danger long-term that could be even worse. So let's use that as a way to kind of segue into what I think is I don't know if you would call it the central recommendation of your book, but certainly something I hadn't heard before, which is this notion of, hey, let's find ways to deepen the interdependencies between China and the U.S. And you have this concept of mutually assured, financial mutually assured destruction, which sounds kind of scary, but in actual fact, I think it's quite a positive idea. So could you explain to the listeners what you mean by that and how you could see that eventually developing?
Well, this concept arises out of work that I did while I was at the Hong Kong Exchange. We put in place this scheme called Stock Connect, connecting Hong Kong's market with the mainland Chinese market, that allowed two-way investment flow between the markets from each other's market. The way that has developed, I think, gives a template for how these issues might be thought about. Today, 70% of all international investors' holdings of Chinese domestic shares are held through Hong Kong Exchange and its clearinghouse. And the reason why international investors choose to go that route rather than to go directly into the onshore market is because they believe that Hong Kong, with its essentially English common law systems and international standards of regulation, gives them greater legal and regulatory protections for their property rights versus going directly to the mainland market. But ultimately, laws and regulations can be changed, and the relationship between countries and levels of trust, there's an ebb and flow to that. The system, though, actually underlying that system, there is a deeper structural protection for investors on both sides. The structural protection there is that when an international investor sells his or her shares in mainland China through the Connect scheme, the obligation to deliver them back their money falls on Hong Kong's clearinghouse. If the mainland authorities were to prevent the Hong Kong clearinghouse from fulfilling that obligation. It would put the clearinghouse into default, which would mean that the clearinghouse could not fulfill its obligation to deliver back money to mainland Chinese investors who had invested in Hong Kong. So to put a rather crude sort of description on it, the protection for everyone within that system lies in the fact that everyone's actually got a gun against each other's head. And so this is something, as China pursues the next phase of its capital markets internationalization, particularly in the current atmosphere of geopolitical tensions and lack of trust. I think financial market infrastructures can play a big role in creating structural protections for both sides so that the two sides can interact in financial markets in a way that both sides feel secure.
When I was just following up on that, because you did talk about, or as I was reading about this idea of using kind of Hong Kong depository accounts, the thing that popped in my mind was, okay, yeah, it's one country, two systems, but in the end of the day, it's the one country that matters. And I think what you're saying, if I understand it correctly, is yes, that's right, but as long as the obligations are kind of both ways, if the Chinese if the Chinese government decided to freeze foreign accounts, that creates problems for the clearinghouse, which in turn creates problems for Chinese investors. That's what you're saying, right?
Exactly.
So to kind of extend that, so for this notion of financial mutually assured destruction to be to work, does that require there to be kind of a rough balance of investment kind of going both ways that's held through, in this case, the depository accounts in Hong Kong, so that if we decided to blow each other up, then the losses are kind of fairly balanced?
Well, I mean, it doesn't necessarily have to be entirely equal, but it needs to be a system in which every party to it has enough to lose that they have no incentive to blow it up.
Gotcha.
Effectively. And so when you take it a step further, let's take China's situation today. So as the population ages, it's got China, like the United States, has an unfunded public pension scheme, which means that inevitably China's government is going to have to issue more debt in order to fund itself through meeting the increase in social welfare spending costs. And so it needs to internationalize demand for its sovereign security. One of the big challenges that China faces today is that it doesn't, international clearinghouses and other major users of collateral don't accept Chinese government securities to meet their margin requirements. So
why is that? Why do they not accept?
A lot of it, frankly, is just habit, right? I mean, there's a tendency to hew to kind of what's tried and known, and so it's not just Chinese government bonds that are not accepted widely as good collateral. You see that with a lot of countries across Asia. Their sovereign securities are not widely accepted as good collateral in international markets either. And so by enabling Chinese government securities to be accepted as good collateral, to be able to get short-term liquidity against them in international markets, that could help accelerate the uptake in demand for China's sovereign debt, which means that there's a very natural nexus between Hong Kong possibly as the depository center for those, because everyone's happy to take a pledge of collateral under Hong Kong law. It's an English common law system, effectively. It's well understood. The nexus between that and the centers that use that collateral, the largest of which obviously is London, because of the London clearinghouse's position as the 90% of the global swaps market. or the clearer for 90% of the global swaps market. That natural nexus could provide the mutual benefits and protections that I talked about that exist in the Stock Connect system.
So your vision is one where, say, the London Clearing House accepts Chinese government bonds as collateral, which then, kind of further deepens the financial interconnectedness between China and the Western financial system, and therefore, kind of reduces the incentives for both sides to, kind of engage in the sort of weaponization of currency as that we've seen kind of recently. Is that broadly speaking what you're trying to get at?
That's exactly what I'm trying to get at.
What's your take on how likely we are to go down that path? Because honestly, it feels that we may go the opposite way, right? That we may have a kind of competing financial systems, like an RMB system that gets developed and a U.S. Dollar-based system that competes instead of works together.
That's the key risk that I was concerned enough about to be motivated to write this book, because ultimately, if the two countries and other countries can't cooperate and coordinate to restructure the system, you may go into a sort of more fragmented system of global reserve currency. So your colleague at Berkeley, Barry Eichengreen's co-authored this paper that the IMF recently put out, arguing that the global currency regime or the central bank reserves are already fragmenting into multiple different currencies. I think that will happen to an extent, but when you look at market shocks, still ultimately liquidity congregates generally around a single or very small group of currencies. And the reason why they do that is because of essentially the scale efficiencies that particularly the US dollar enjoys, because you have a whole system of collateral globally which depends on US treasuries serving as risk-free assets. You have commodity contracts that are priced in US dollars. You have interest rate contracts, you have FX contracts that all reference the dollar. That is an incredibly powerful ecosystem that entrenches the dollar as the globally predominant currency. But you can also argue that the US dollar has been through a number of tipping points already that would or might have been expected to precipitate its downfall. Whether that's in terms of the extraordinary level of government debt that exists today, or the fairly gratuitous monetary expansion that you've seen, particularly over the last 2 years, to the US's abuse of its position to weaponize the dollar against its strategic rivals. Now, the dollar has defied the doomsayers, but ultimately, and we've seen this time and again through history with rises and falls of global reserve currency, whether it's the pound sterling or the guilder, there will come a tipping point at which the dollar cedes that global reserve role to another currency. Unless the stakeholders in the system come together to plan what the future of that system and what the next reserve might be, then you could see in the short term, when it happens, very catastrophic market volatility, which will have social consequences and societal consequences. But even in the long run, if another country's currency ascends to usurp the US dollar's role, then that country and the infrastructures that come to serve that particular unit in the global monetary system will inherit a huge amount of power that the US enjoys today. And I would ask US policymakers to think very seriously, okay, you can do nothing right now, but how would you feel if another country, possibly a geostrategic rival, came to dominate the global financial system to the extent that the US does today? And I think that it would be, or it might be argued, that it would be in the US's enlightened self-interest to take a proactive role in pursuing a more neutral global financial commons. And in fact, this is something which the Chinese have offered. If you recall, in 2009, just after the global financial crisis, Governor Zhou, the previous governor of the People's Bank of China, made a speech in which he advocated not the renminbi to take a larger role as a global reserve currency, but for the IMF's special drawing rights to take a larger role. And that's a position that was reiterated by his successor, Yi Gang, in the middle of 2020 in a Financial Times op-ed article. And I think that there is the opportunity now to find a more neutral way forward, not just for the two countries, but for all stakeholders in the international financial system.
And I remember that quite well. And I remember thinking, well, the U.S. will never kind of voluntarily give up what it perceives to be, a powerful lever. But that may change now. And I agree with you. I think the freezing of central bank assets of Russian central bank assets is going to be looked at historically as the key moment of, the peak in the dollar system. I mean, if you're a reserve manager really anywhere outside the close nexus of U.S. allies, you have to be, I think you have to be thinking of a way to diversify your reserve assets. Do you think that China would still support that kind of notion of a maybe not an SDR, but a kind of a more neutral reserve currency? They'd still, if the U.S. said, "Hey, we're willing to consider that proposal," would they come to the table and talk about it?
Absolutely. Look, China's pursuing steps to internationalize renminbi not as a first choice. The reality is that Chinese policymakers have looked at the enormous costs that the US has borne for allowing its currency to serve in this global utility role, and they've actually been quite wary and reticent of allowing their currency to step up and absorb the financial imbalances from the rest of the world. And so they are only pursuing these steps towards the internationalization of the renminbi in absence of a better option.
Yeah, that's interesting again, because that's sort of not how it's presented here, but it's presented more as gradually trying to take power. But you're right. If they inherit the advantages of a reserve currency, they also inherit the disadvantages. The primary one, I think, must be they would have to free up their capital account and therefore lose some kind of control over the value of the currency, but also how individuals are holding their money, and they might be able to get their money out of China. Again, is that where you see potentially a role for Hong Kong in terms of, allowing Chinese investors to hold international securities, but in a way that, if it's done through Hong Kong, it still allows the central government to kind of understand and monitor that?
Well, I mean, the Chinese face some significant challenge. So we talked about the challenge of financial security risk by through dependency on Western-controlled financial infrastructures. But you also got the issue of just very mundane things like anti-tax avoidance and anti-tax evasion. China doesn't have the power to impose FATCA on the rest of the world. So if they allow their citizens to go out and set up accounts elsewhere in the United States or Singapore or wherever it is, then it is far less easy for them to track that their own citizens are paying the appropriate amount of tax. So, I mean, there's certainly a role for Hong Kong in helping to intermediate that, to give the Chinese authorities the same level of transparency that the US has managed to achieve through things like FATCA. And you know, it's also a center because of its unique status as part of China, but running, you know, an internationally recognized and accepted legal regulatory system. It's also a center in which, you know, Chinese can hold international securities and you know, thereby derive the same benefits that Hong Kong is giving to international investors investing in the Chinese domestic market.
I know we're getting close to running out of time here, so I wanted to ask just a final question. In talking to people here in the U.S., I know you've talked to academics and some policymakers. What's your sense of their appreciation for the perspective you're putting forward in terms of what China is looking to do with its currency, and what, how open do you think the people you've talked to are to the perspective of kind of deepening the financial integration between the two countries instead of competing?
As you'd expect, I mean, there's a multiplicity of different viewpoints. Generally, people are extremely courteous and polite when they're speaking to me, and I perceive a sense of open-mindedness in many quarters, you know, for reforms. You know, whether or not that seeps through into the kind of top echelons and the official position, I don't know.
Well, listen, James, thank you for taking the time to talk to us. And it's a book that I think we you know, people here in the West could really benefit from reading, to get this kind of different perspective, both on the history and also, you know, the possible ways forward. So thanks for writing the book, and thanks for taking the time to come and chat with us today.
Thank you very much, Kevin. It's been a pleasure.
Okay, Niels, we'll pass it back over to you.
Thank you so much, Kevin and James, for a fantastic conversation. The relationship between the US and China is perhaps more important today than ever before. And to get a first-hand account from James on what was behind the crackdown of technology firms in China, as well as the for-profit education firms, is really eye-opening. And the possible solution that James talks about in terms of creating more interdependencies in a way that would make it unthinkable for either the US or China to wield their financial arsenals against each other, and thereby enhancing safety of both, is very, very interesting. Make sure you go and follow James and Kevin's work, as well as getting a copy of their books, because as you can tell from today's conversations, some of these ideas and topics are not being discussed on mainstream media. From Kevin and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.